Wilkins, and then go on to questions. I have a list of those who would like a question. If I did not get your name, please raise your hand after we get going, and I will put your name down. Please limit yourself to one question and one follow-up. The only thing I ask is that all phones be turned off so we aren't interrupted today. We will start with, as I said, with a statement from Ms. Wilkins, and I will now hand it over to you. Thank you.
Thank you. Bonjour. Le gouverneur Poloz et moi sommes ravis d'être ici parmi vous pour discuter de l'annonce de ce matin concernant les taux d'intérêt et du rapport sur la politique monétaire. Avant de répondre à vos questions, permettez-moi de prendre quelques minutes pour vous exposer les principaux points qui ont été abordés dans les délibérations du Conseil de direction. Essentiellement, les forces sous-jacentes qui favorisent un raffermissement de la croissance au Canada restent les mêmes et le processus d'ajustement de l'économie au prix du pétrole moins élevé est bien engagé. Ceci dit, des facteurs internationaux et nationaux nous ont amenés à revoir la baisse de nos prévisions pour la croissance du PIB. Ce qui est important pour le Canada, c'est que l'activité économique est fondamentalement vigoureuse aux États-Unis, même si la composition de la croissance dans ce pays est un peu moins favorable pour le Canada qu'elle l'était en avril. Les conditions sur les marchés américains du travail sont relativement solides, les consommateurs sont confiants et le taux de création d'entreprises est presque revenu à son niveau d'avant la récession. Tout cela donne à penser que la faiblesse affichée au début de 2016 était en grande partie temporaire. The U.S. economy remains a key driver for global growth, which we forecast will strengthen gradually to 3.5% in 2018. However, the results of the referendum in the United Kingdom have clouded the global outlook. Governing Council carefully considered how to best incorporate the effects of the Brexit vote into the outlook. It's early days, and there will be prolonged periods of uncertainty as authorities work out how the United Kingdom will exit from the European Union. Governing Council decided to incorporate in the base case projection a 0.2 percentage point reduction in the level of global GDP by the end of 2018. And this reflects direct trade effects and some confidence effects on business investment. We're assuming that the Brexit process will proceed in an orderly fashion. Financial markets were resilient despite adjustments in a wide range of global asset prices in the wake of the vote, and financial conditions are generally more accommodative. Now let me turn to the Canadian economy. Our discussions focused on how we should look through the choppiness in recent data to see the underlying trends and what those trends mean for the inflation outlook. Among other factors, the fires in northern Alberta, which have been costly for many, represent a sharp but temporary hit to the economy. We expect GDP to fall by 1% at an annual rate in the second quarter and then grow by 3.5% in the third quarter as oil production resumes, rebuilding around Fort McMurray commences, and the new Canada Child Benefit lifts consumption. In fact, fiscal measures, including infrastructure spending, provide an important support to growth over the forecast horizon. We've always said that the adjustment to the oil price shock would be a complex process, and we see evidence that these adjustments are happening thanks to the resiliency and the flexibility of the Canadian economy. On the energy side, firms have been quick to cut back investment plans and reduce costs. By the end of the year, we expect these reductions to be largely over. On the non-commodity side of the economy, we've also seen evidence of adjustment, but it has been more uneven. Export data have been particularly volatile, and it's very important for us as policymakers to assess underlying trends. We see that what we see is that non-commodity exports over the past couple of years have been responding largely as expected to growth in foreign activity and the Canadian dollar. And businesses are telling us that they are benefiting from stronger demand and a lower dollar. We have a great chart in the monetary policy report that shows that non-commodity exports have recovered almost to their pre-recession peak, which puts the recent volatility into perspective. Exports are projected to grow in line with the U.S. economy over the projection period. We're being conservative by assuming that exports only make up part of the ground lost over the past 4 months. The past appreciation of the exchange rate will continue to support the level of exports, but its effect on export growth is projected to taper off over the course of this year. Growing demand for Canadian exports should lead to increased investment and new businesses being created. The question for monetary policy is when and by how much. Governing Council still believes that investment will be needed to expand productive capacity as both foreign and domestic demand increase. And you can see that this rebuilding process is well underway in the United States. And we're seeing early signs of new firms are also being created in Canada. That said, our profile for investment, while still positive, is lower than it was in April. And that's because investment data have continued to disappoint, and some businesses are telling us that they remain cautious. Now, let me make a point about the lower investment profile. It doesn't just mean slower growth in GDP. It also means a reduction in the economy's potential, although to a lesser extent. And when you add it all up, we project that the output gap will close toward the end of 2017, somewhat later than we forecast in April. The uncertainty around potential output remains high because it's not clear how much productive capacity will ultimately be rebuilt as the economy strengthens. En ce qui a trait à l'inflation, nous prévoyons qu'elle se situera en moyenne à 2% en 2017, à mesure que l'écart de production se rétrécira. Notre prévision au sujet du processus d'inflation s'appuie sur 2 notes analytiques du personnel publiées aujourd'hui. La première note montre que les pressions salariales sont modérées par rapport aux données historiques, ce qui concorde largement avec la marge de ressources inutilisées sur le marché du travail. La deuxième note porte sur les facteurs structurels qui aident à expliquer les mouvements récents des prix des produits énergétiques de consommation, des aliments et des services. Enfin, comme d'habitude, un certain nombre de risques pèsent sur nos perspectives d'inflation. Nous jugeons que ces risques sont relativement équilibrés. Cependant, le climat général est caractérisé par une incertitude accrue. Dans un contexte de faiblesse persistante des investissements à l'échelle mondiale, une nouvelle dose d'incertitude pourrait inciter les entreprises à rester sur la touche plus longtemps. Not surprisingly, Governing Council also spent some time talking about housing. We continue to have the same concerns we expressed in our June financial system review about household indebtedness and housing, particularly in the Greater Vancouver and Toronto markets. The circumstances that the Canadian economy is facing make the bank's risk management approach to monetary policy particularly valuable, because the types of uncertainties we see cannot be readily incorporated into projections. In light of all these considerations, the Governing Council maintains a target for the overnight rate at 0.5%. And with that, the Governor and I would be happy to answer questions.
Okay, we will start with Richard Madden, CTV News.
Yeah, good morning. I wanted to stay on housing. In your MPR, you talked about the markets in Toronto and Vancouver using the words indebted households have exacerbated vulnerabilities in the market. I'm wondering if you see an elevated risk of a correction today versus a few months ago?
Well, we haven't changed our view from the June financial system review, where what we noted, as you say, is two things. One, on the housing price side, we see that the housing price growth can be explained in part by fundamentals, not only land supply issues and the fact that those places are popular places to live, but also because the adjustment that the economy is going through right now is favoring, in a sense, growth in Ontario and British Columbia. You see that in employment data. At the same time, we just got some new data. House price growth year over year of 10, 20% just doesn't look like the growth in those fundamentals are going to keep up with the growth in that price. And it's in that sense that we say that those growth rates are unsustainable.
Okay. Just trying to drop it, sorry about that. Also wanted to just weigh in on the Brexit. You did cite that it's going to shave the global growth. Do you see that impact on bonds and how that could affect mortgages in the medium term in Canada?
So the implications of Brexit that are the clearest right now are, first of all, what's actually happened in financial markets, so in pricing of assets and what we've seen. I mentioned an easing in overall financial conditions. You can see that yield curves globally have flattened. And so to the extent that that leads to banks and other mortgage providers to reassess what prices they want to charge for their mortgages, it could lead to lower prices, but that's a complicated process because it depends on their own funding costs as well. With respect to the other effects of Brexit, what we've taken into account are really the direct trade type effects, some effects on investment that you can measure given the structure of the economy today. As we know, the trade links between the UK and Europe, and also through the US and then back to us. That's the channel. What is more difficult to put in, and in fact I would say you just can't put it in, is the uncertainty about what the UK's relationship with Europe will look like when it's all done. And given we know it's going to be a longer process, what uncertainty, should it arise and go through financial markets, what that cost in terms of growth will be, if any. I mean, what we saw more recently was there was a lot of volatility, a lot of repricing, but markets functioned quite well. And in fact, I would say that you could see some of the benefits of the higher capital and higher liquidity that has been put in place across the globe.
Gordon Isfeld, Financial Post.
In your statement and in the MPR, you discuss the benefits of the Canada Child Benefit Supplement, also the infrastructure coming from the federal government. How do you quantify that, and when might that start to be felt? I know child benefits, there is a bit coming in now, impact, but on both, how do you quantify how much impact that's going to have on the economy, on your outlook, and then especially when it comes to the federal infrastructure spending?
Right. So these questions are the same as they were 3 months ago, when we just had the announcement, and they're embedded in our forecast, just as they were then. And what we see is an additional of 0.5 percentage points to growth this year, coming from the budget. Sorry, I should say 0.5% is the average over this year and next year, in addition to growth. So the level of GDP is estimated to be about 1 percentage point higher by the end of 2017 than it would be without the fiscal change. So I think in the table it shows 0.4 and 0.6. That isn't, you can't take that as just the budget effects. There's more stuff in there, and some of the budget effects come through the consumption line. So that's important to bear in mind. So they're not apples to oranges comparison. So the important thing is that those details are contributing to growth meaningfully. 1 percentage point on the level of GDP by the end of 2017, you can back that out and say, well, the output gap would still be 1 percentage point wide without those changes at the end of 2017. So we wouldn't be sitting here saying, oh, the output gap is expected to be closed somewhat towards the end of 2017. We'd have a different narrative around that. So that's, there's nothing extra special in there. Those numbers have changed slightly since April, but it's not because of the impact of the budget that's changed. It is what has changed is the history was revised, so that through the national accounts revisions, so we have a different starting point for the contribution from G.
Just to follow up on that, I mean, even the federal government is saying that this money really won't actually get into the ground, into the ground until next year.
Yeah.
So again, we're looking at estimates.
I understand. There's uncertainty, especially on the infrastructure side, at what pace the spending actually gets converted into on-the-ground spending. So the government is in the process of signing individual agreements with provinces and so on. So that process takes some time. But my understanding is that there is a strong readiness with projects. Like it's not, people aren't then going home to think up projects. That process was well advanced. There's been plenty of warning about it, so people know what they would like to do first, second, third. So we shouldn't see long delays in terms of permitting and all those kinds of things, which would be the case if you're starting from scratch. So we do think that some of it is going to begin to enter the data in the second half of the year. But I don't want to be pinned down on how much. It's just, it should be starting to show up, and we'll just have to monitor GDP. We don't have a specific measure of this. It'd be more like how is it interacting. The other source of uncertainty, as you've alluded, is around the effect of things like the child care benefit, how it affects consumption spending. And so in the case of this new formulation, when people receive that, I believe they'll know that there's no clawback, that it's theirs to spend, et cetera. Whereas in the past, there's been some uncertainty about what would your net taxability be and so on. So there's less uncertainty around that. And so you can make sort of average estimates about how much do people spend as a share of their income and apply that. And then, of course, when they spend it, it has secondary effects. So normally economists would put a bit of a multiplier into their model to calculate the total effect through time. But it happens this year. It's already July, so it starts now. Then it becomes part of your base from then on. So importantly, it only affects growth in that first part.
Marul Vidayanath with the Epoch Times.
Yes, thank you and good morning. So we understand the Brexit to be a key factor in the lower outlook, and you touched on the resilience of financial markets, the reaction to the Leave vote winning. Given how the stock market has moved to record highs now, and bond yields are still near record lows, how can that be reconciled, or is there some irrationality on the part of equity markets in relation to where bond markets are, maybe where gold has risen recently?
Yes, well, there's no question. First of all, we're still in early days in understanding the actual shock, as Carolyn said. It's not the case that every stock price is back to where it was before the shock. We definitely have, seen a rewriting of the values of banks in a lot of stock markets, and so it does suggest, though, that the risk-off reaction of markets was a temporary one, but they've gone back on. But at the same time, as you said, the impact on bond markets has remained. Now, there's more than one way to read that. One would be that we still have unconventional monetary policy underway in Europe, which is an important part of the story of how global bond markets are reacting. All those yields tend to be highly correlated. And so we have that. We have some degree of flight to safety in the wake of Brexit in certain markets. But what we also have, as we emphasize in the report, these unmeasurable or unquantifiable risks around what does it look like? What does the new arrangement look like? how does that affect the business outlook? How does an individual business person make up their mind about whether to invest today or to wait until after they know? So we've been for quite some time trying to understand the fundamentals of investment globally in the wake of the global financial crisis, and where we lean is to say that that experience, the trauma of that experience, has left people uncertain and unwilling to take as much risk given the same information set as before. In other words, they're more tentative or more risk averse, and so it's taking longer for investment to recover generally around the world. And if that uncertainty layer has now been given another reason to extend further. And so if you characterize it that way, that risk is larger than it was before. And it just means that we may have to wait longer for clarity and for that to recover. And that would be my own interpretation of what bond markets are telling us, that the global growth story is being stretched out further because of that uncertainty impact. And it's not just Brexit per se, but any sort of political developments that might affect your investment decisions. It's a U.S. election year, so a lot of things that might affect the way you would plan for your company can be in play during an election. The rhetoric maybe doesn't match how things end up, but the point is that it raises uncertainty for your business plan, and so you have more of a tendency to wait until that's a little clearer. So a postponement, if you will. So we've incorporated some of that, as Carolyn mentioned, but the rest is actually, you really can't put numbers beside it. You can only think through, well, what if it was noticeably weaker than what we've built in? What would it look like? And that's the sort of thing we do to kind of inform our risk management discussion.
So was it like how did markets get the vote wrong and thus have to reprice themselves? Like,
Well, look, I don't know. In just a few weeks, very soon before the thing, it was close to a 50-50 on the polls, and I thought my own sense going into it was that markets would kind of move either whatever the result was, because half of the market would have to adjust. But in just a few days beforehand, there was a bit of a significant shift, I guess, towards one side, and that meant for a larger adjustment. As Carolyn says, I think the best thing out of all that was that there were some big moves, and markets took it well. They did not get disrupted. There were no gaps, and so I think that's a good test for how markets can function in the face of something that was quite unexpected, even though you knew the day it was going to happen. Most shocks happen on a day you don't expect, as well as being unexpected. In that case, there had been a lot of preparation in the financial sector, so that they were well liquid and ready for, I think, either result.
Greg Quinn, Bloomberg.
Good morning. The forecast took a big bite out of the contribution from exports this year, and much of the other discussion seemed fairly optimistic about what the prospects for exports from here. But we've had a long period where exports have not done as well as thought. So what is it about this moment that means now is the time when everything comes together the way you say it will?
Right. Well, I'd like to take you back to April, if I may. So 3 months ago, we were riding a very big surge in export data during the winter, which to us was surprisingly strong and actually very difficult to explain. It was tempting to take that as finally we got some good news on the export front. But instead, given our deeper analysis, we concluded that it was probably an overstatement of the underlying trend. So that was important. If you go back to that conversation in this room in April, we were talking about let's not get carried away by extrapolating that export trend, and of course, it turned out to be correct. It was not just trends, but in the underneath, we look at the granular detail. So an example would be like auto production was really strong in those months. There was a lot of auto trade, and we knew that auto production was about to be reduced to more normal levels or even below. So we knew that would impact trade, but that's just one example among several. So we had intelligence around that. We had weather effects and so on that can distort some of these data. So that's a bit of the past. So seeing through that bump up, I think allows us then to also see through some of this the last 4 months. I'd characterize them as disappointing, but disappointing not in the usual way, but disappointing in a surprising way. Difficult to explain in the same sense that the uptick was not explicable either. So, but the data are, I think, the trend line is better explained in that chart 6 that Carolyn mentioned in her opening remarks, which shows that the export recovery is alive and well. We have this, you kind of have this narrative that nothing's happened, and yet what we see is actually 7 or 8 years of recovery, a slow recovery for sure, but one that's been steady and is now pretty well done. It's back to where we were back in 2007, give or take a little bit. It's just got to go a little bit further to get there. And when you consider the trauma of what that plunge in exports did to the Canadian economy, that in itself is an impressive outcome. And it happened on the back of the global recovery, especially the U.S. recovery. And of course, in the last couple of years, buttressed quite a lot by the exchange rate decline. So we think all those pieces remain intact. That if you look at the weakness in the last 3 or 4 months in that chart, it's very hard to see. And that's because you put it into that perspective. You see, it's just the usual kind of volatility, maybe more than usual volatility. And so we try to see through that, and we think the fundamentals are still there. It's true that the exchange rate effect, the exchange rate hasn't moved down much for quite a while. It's been relatively in a range. So by our models, probably most of the acceleration of exports due to lower dollar is mostly done. So from now on, it supports, or say by the end of this year, it'll be mostly done. So the next year, the lower dollar continues to support the level of exports, but it doesn't cause additional growth. So basically, we've taken a conservative assumption that exports grow roughly at the pace of global demand, which is primarily U.S. demand, and that we do not assume that the shortfalls in exports of the last few months all come back, because that's what we mean by conservative. We don't assume it all just gets right back to normal right away. That a little bit it does, but it takes quite a long time. So we're being careful about not making it too, an excessively rosy prediction. It's just, I think, a positive one because the fundamentals are positive.
Is there some urgency here in terms of your policy in this picture changing soon? Getting away from a period of, repeated short-term disappointments in exports and repeated signals of a housing market that's getting out of hand in Vancouver and Toronto. If this picture doesn't change soon, is it by itself dangerous for Canada's economy?
Well, that's a pretty broad question, Greg. I think for us, what matters is what's inflation going to be, and as characterized, a big share of both the historical revision to the accounts and our own revisions to the outlook is in the both for the U.S. and for Canada is in the investment space. Because it's an investment revision, that means it feeds directly into our calculations of potential output. So that means that the gap doesn't move as much as it would if potential output were holding still. And it's the gap which matters to our outlook for inflation. And so that's why all those revisions we talk about to the outlook have only a modest effect on the risks around the inflation outlook, and that the gap still closes, reasonably. It's later, obviously, but not tremendously later. It's in the similar window. Given the uncertainties we face, it's very similar timing, and inflation is on target in 2017. Did you want to add something about that?
Sure. We've talked a lot about the destruction phase. So in the recession, a lot of companies just disappeared, and so at one point, as demand rises, existing companies are going to bump up against capacity pressures. You see some areas where that's happening already, but also new firms are going to be created, and that equation that businesses have in their mind. Reflects what they think the payoff's going to be to that investment. So they want to know not what growth is going to be next quarter. They want to know what it's going to be over a medium term. They're going to want to know what their tax environment is, what their operating costs are, like electricity. There's a lot of things that they need to know, and so just the dollar, which people talk about a lot, is just one part of that equation. And so that's what companies are thinking about right now. Some of them are taking the plunge and deciding to invest, and others are saying, I need a little bit more time. And that's where the uncertainty comes from, because just as one example, the Canadian dollar, we've got past appreciation relative to the US dollar, but if you look at the cross with the peso, as an example, you don't see that same depreciation. In fact, the Mexican peso most recently has depreciated against the U.S. dollar. So those are the kinds of factors that businesses take into account. I mean, clearly there are lots of opportunities in Canada. When we look into all those detailed data, that's what we see in different areas. So what happens in the future is going to depend on which sector. But clearly, the recovery and the strengthening, the solid growth in the U.S. economy is key to that projection, and we feel confident that the U.S. economy the momentum is there.
Andrea Hopkins, Reuters.
Just to stay on that export question, I'm wondering if you can expand on why you have faith in this recovery, when others have said you are too optimistic, these serial disappointments that others have overestimated as well in their forecasts, but are now tend to be, or at least the ones I've talked to are less optimistic than you are, then these are truly coming back because of some of those structural things that you've mentioned.
Is your question specifically about exports?
Yes, non-energy exports.
Oh, and you've seen chart 6.
Pardon me?
You've seen chart 6 in
Yes.
the MPR.
I have.
Okay. That's a lot of growth in non-commodity exports over the last few years, and especially over the last 2 or 3 years. So that tells us that our models told us all along that this would happen. So that keeps our faith in the core narrative. Now, around that narrative, you go through periods of angst where they're, like in the last 3-4 months, exports have underperformed our expectations, true. But as I said, for the 3 or 4 months before that, they outperformed those expectations. So we have to continue to look through those things, and we resist the idea of turning 180 degrees on our forecast because of the last few data points. And I think that's appropriate. And the proof will be in the longer-term data. Those are the things that frame your business environment. It's what frames business decisions. It's not the last couple of months that do those things. So it may be that serial disappointment is behind all of this. You're absolutely right. That is a multi-year thing, and as you know well, we're not alone in that. That the IMF gives a great summary of how the revision process has gone at the global level. We all share in that. But when you have, say, 20, 30 years worth of experience, which is the basis for your understanding of how the economy works, call it a model, when there's a major disruption to that, such as there was in the global financial crisis, you can surmise that somehow the model is not going to be able to deal with it. Certainly not at the time, but you begin with the presumption that fundamental behavior will be similar to the past once the dust settles. And as it isn't, you gradually learn through that experience that you need to be adjusting your model, the parameters, the behavioral assumptions that are in it, But you can't do that on only a short period of data. This is something that you learn as you go. Is it possible to revise your expectation dramatically lower to make sure that you've captured all the possible downsides? Well, of course. But I think that would be worth understanding, which was the sort of thing we do, to do counterfactual scenarios so we understand them, so that we understand the downside risks that we may face. But I think it wouldn't be the right thing on which to base today's policy. What it does is it helps inform that risk management discussion.
Is the dollar, if I could ask, is it too strong for the kind of recovery in the export sector that you had hoped for?
Well, as Carolyn said in her opening remarks, the trend lines in the export sector are very similar to what we've been calling for. Where we have a bit of a gap is between the rate of growth of our exports and the rate of growth of our formulation of foreign demand, which is a complex amalgam of U.S. growth, other growth, and the composition of U.S. growth. The composition matters. So when you have shifts in the composition of growth, for example, in the U.S., we had, in the early parts of the recovery, we had primarily a consumption recovery and not an investment recovery. And we had low government spending. So this was a different mix from the normal mix of growth in the U.S. Well, that shift in mix had a significant implication for the mix of trade flows, because it so happens that government spending and investment spending especially are highly trade intensive, more so than consumption spending. And so for a while we had to adjust down our expectations, because along with the outlook for investment in the U.S. And when investment began to pick up, sure enough, we had more exports in Canada. And what happened was, in this past cycle, the downgrade that we've incorporated here is because there was significantly lower investment spending in the U.S., mostly in the energy sector, which is understandable, hard to predict, and we know there's a big adjustment happening there, but also in spillover in other sectors. And so for that reason, we've downgraded our line for the export outlook. So we have purposely been very conservative with our export outlook. So if what you hear is it's sunny, I think that's not correct. What it is realistic based on the negatives that we've seen and us seeing through the volatility which we have tried to sort through.
But you didn't comment on whether the dollar is too strong.
That's right, I didn't.
We're going to have to move on now to Kim McCrail with the Wall Street Journal.
Hi, thanks for taking the questions. I just wanted to go to a risk that was mentioned at the end of the monetary policy report today, the risk about sluggish business investment. And you highlighted there that there is also a risk that could signal that there are demographic forces or other structural factors at work that are more relevant than was previously expected. Can you describe how that would apply in Canada? Would there be demographic factors in Canada that are impacting business investment?
Sure. At the global level, what we're seeing, and we've incorporated, is a demographic trend, so aging of the population that results in lower growth and potential output. And in that environment, the returns to investment are just lower, and you get less of it. And the question is, to what extent is that drag coming from demographics and other structural factors, less globalization, less trade? How is that impacting other factors that affect potential, like productivity, for example, or the efficiency with which you use the workers and the capital that you have? And so there's a lot of uncertainty about that, and how that, I mean, clearly Canada has the same demographic trend, and we have put that into our forecast. I think what's interesting for Canada is really the juncture that we're at in this rebuilding phase, and the decision that companies and potential entrepreneurs need to make about whether they're going to invest. And where demographics come in is that there's a lot of smaller companies or medium-sized companies that have owners and people who have developed this company who are getting older and maybe thinking of retiring, and so that demographic factor can be important in the future for these particular companies, but also whether or not they're going to want to grow to get bigger, or whether or not they're going to want to start new companies. So here we're relying on younger people to prendre la relève, to take the relief from that. I think more generally, when you look at that investment story long term, I mean, it's looking like some of it's cyclical. That's why we expect investment to pick up. And once that happens, you may also have an effect on the labor market where some of these discouraged workers actually come back as well. And so that combination of more investment and workers coming back into the labor force only add even more to potential. So I think we talk a lot about the downside risk, but there's also some upside risk too.
Wanted to return also to the question of housing pressures in Vancouver and Toronto. In December of 2014, you put out some estimates based on some modeling that Canada's housing markets were 10 to 30% overvalued. I'm curious if either that's been updated on a broad level, or as well if you've looked at those specific markets, because it really does seem to be an issue of two markets being overvalued.
So that 10 to 30% was a reflection of the market, the Canadian housing market overall, and so that's really not relevant right now for the situation that we face. I mean, you pointed it out. What we're looking at is the Greater Vancouver area and Toronto, and we do not have models that specifically look at those. What we do is analyze the situation, the fundamentals, and then make an assessment about whether that rate of growth looks sustainable. And as we said in the financial system review, it looks like the risk that it's not is increasing.
So there's no modeling for specific
Not for specific cities.
No, and I'll just add that model was a piece of research which was actually global. So it analyzed 60 or 80 examples of high price growth in various markets. And the idea was to try and find the common factors that happen in markets where prices accelerate like that. And so it had none of the things you would need to actually customize to our domestic situation, like a lot of the arguments that you would use to try to analyze our own local markets were not in that global model. So at the time we said all that. We said it was just a piece of research to help inform the discussion. A lot of others were laying out estimates from different methodologies of overvaluation. So there was a wide range of possibilities you could have chosen from at that time, and I guess there still would be. We don't want to make a statement that's like somehow definitive around that, except that as we've said, that the prices appear to be outpacing anything you can write down as fundamentals, and there can be a concern if people are basing their decisions on an extrapolation of those things, as opposed to whatever their own realistic situation is. And so the onus goes to borrowers and lenders to understand those risks. I think for us, therefore, the risk that there could be a period of either flat or declining prices in a market like Vancouver, that risk is rising, but not really quantifiable. It's clearly rising.
Unfortunately, we are out of time today. The governor and senior deputy governor have to leave by noon. Thank you very much for your time, and have a great day.
Thank you. Thanks very much.